started. Today's webinar is a little bit about the American stock market, and I'll have a little bit of a monologue for maybe 5 minutes or so, or 10 minutes, and then we'll start with the Q&A. So while you are seated listening to me, if you hear something that you feel like you don't understand or wish to know, just write down those questions. Or if you have questions ready, just get ready, write them down somewhere, or prepare yourself to ask them. Now, the stock market. There are a few things about the stock market. So what is, I know a few people know what stock market is or what stocks are, but for those who don't know, is a stock is a share of a company, and the people who own that company have equal share to that company of when it comes to ownership. And sometimes some of these companies, in order for them to attract more investors or more owners, they put out what we call an IPO, where now they invite other people to join in and become investors. So if you join in to become an investor in a stock or a company, then that means you're buying a share of that company and you become a stockholder. And as a stockholder, now you have the privilege of growing with the company, sharing its profits, dividends, and all that. And then at the end of the day, when the company grows, you'll end up also growing your investment. So the stock market has a variety of issues when it comes to risks and losses. So before you decide to invest, consider some of these risks and make sure you have enough money to cover your losses, which means you don't want to invest money that you would have used to pay rent or pay school fees or other necessities to invest in the stock market. So if you're investing in the stock market, just know that that's money that you're willing to risk, and if you lose the money, it won't affect your daily life. And as a beginner, you might want to work with a financial advisor, and lucky for you, humbly, I'm here saying that I can be your financial advisor. Olympus Financial is a financial institution that helps you with personal finance, helps you restructure your finances, help you sort out your debt issues if you have some. It helps you, invest, plan for your future, plan for retirement, invest in, a multiple of investments. I'll advise you on a few other things that will help you reach your goals in life financially. When you, like I said before, when you buy stocks, you have the advantage of getting dividends, and dividends are just what shareholders get when the company makes profit overall. So let's say this year a company made profit and they're like, you know what, our investors, which is our shareholders, need to be, compensated with the profits we've earned. And they divide those profits into the number of shareholders they have, and therefore you get what we call a dividend. Now, some of the companies, the good companies to invest in, are those that give out dividends, because you're not just gaining by the company growing, but also gaining when they give out dividends, or let's say profits, as the company is doing its own businesses, its own day-to-day business. Now, that's just like a brief introduction of what companies do and what they end up doing when they make profit, and shareholders and all that. Our question of concern today is how to buy stocks, where to buy stocks, and what to do after that. Now, this, I've been putting it out there that you need to have a brokerage account. A brokerage account is just the person who is between you and what we call an exchange. So an exchange is like the market where all the companies now congregate to sell their shares to potential investors. And you being a potential investor, you want a way to connect to the market. And a brokerage company is your connection to that market. So if you're looking to buy stocks, you need a broker to get you to see what stocks are available and which ones you can buy. And the job of these brokers is to make the trades for you. So it's like the middleman. You talk to them and they talk to the market and they buy what you want or sell what you have. Now, in the American stock market, the stock exchange is called the New York Stock Exchange. And apart from the New York Stock Exchange, there is other exchanges like the NASDAQ and other ones. But that, I think I handled that on a different webinar. There's a lot of them in the American stock market as compared to the Kenyan stock market, which has only the Nairobi Stock Exchange. So in the stock market, you have a variety of securities. Securities are things like company shares, which is sometimes called stocks. There's also mutual funds. There's indices or index like the S&P 500. There's ETFs and other things. So if you go to the stock market, you are in the market for a lot of products. And most of these products are products geared to creating wealth and making money for you. So your objectives in going into the stock market is usually to make money. You can do that either through your own ways. So if you have the proper knowledge and education and skills to work it out on your own, you can just go sign up for a brokerage account and do it on your own. Or you can do it through a financial advisor with, say, guidance. They guide you on how to invest. Or the other way they can help you is they can manage your brokerage account. So you just open the account and you say, you see, this is my account. It has 100K. I give it to you. Invest for me through my account. And Olympus Financials, we do that. We can help you invest on your behalf. All you have to do is have your own brokerage account with your capital for investment, and we'll take care of the rest. So the big part of this webinar was how do you get started on investing? So one of those ways is one, you have a brokerage account. You have funded your brokerage account. And now the next thing to do is to screen for stocks to buy. By screening, we mean you're looking for the stocks that meet your goals. For example, if your goals is to do a retirement, you probably want to look into ETFs and dividend stocks or something like that, or mutual funds. But if your goal is to get income, you'll probably look into more growth stocks and dividend stocks. But if your goal is to make high growth in a short period of time, maybe your strategy will be day trading. So you'll have like stocks that really want to move fast within a day, and then with that you can buy and sell and make profit within a day or two, and therefore grow your account very fast. So screening helps you decide which type of stocks you want to buy and for what reasons. And like I said in another webinar, that the American stock market has over 10,000 companies in their stock market. So your goal is to narrow down to specifically what you want to invest in. So part of the screening involves research on the companies. So you've narrowed down to maybe 5 or 10 stocks. Now you have to do a quantitative and qualitative analysis on these stocks. So qualitative is sometimes referred to as fundamental studies or fundamental analysis, where you're dealing with their books, their books to earnings ratios, credit reports. You're doing expenses and revenues and all that. So a company that is doing good qualitatively is a company that has enough profit. They're making good profits. They're making good growth. They're doing good, so to speak, by the books, right? And that gives them an advantage over other companies that are making losses, companies that have a lot of debt, companies that are not doing good, generally speaking. So that's qualitative analysis, which is fundamental analysis. Quantitative analysis is sometimes referred to as technical analysis, where you look at a chart. When you look at a chart, you see like we have candles, we have all these indicators, we have other things that you can use to analyze the activity of that stock, and then thereon make your conclusions on whether you want to buy that stock or not. So the quantitative analysis, which is a technical, is more of what you see and what has happened. But the qualitative, that was quantitative. Qualitative or fundamental analysis is you're looking at its day-to-day business activities and achievements. So once you have an idea of what stock you need to buy, or you have a good clue of its activities, then you make that move to buy them. But today I'm going to give you a few stock screeners where you can now go and choose which stock to buy and which one to narrow down the list to a few that you can put on your watch list, and then therefore move on and invest in them. So one of those is called FinViz, and with FinViz, if you can see on the screen, there's something called a screener. There's a tab for a screener, and under a screener you'll see a bunch of things going on there, but here it gives you an option to choose the criteria you want to filter out some of the stocks that you don't want and have the ones that you want. So there's a descriptive. Descriptive is just the general thing, like stuff like market cap, price. So if you want a stock that is between $10 and $20, for example, you can choose that. Or if you want a stock that is exactly $10 or under, you can select $10 and under. And whatever it does, it shows you only those stocks that are $10 and below. And then let's say something like market cap, which we'll discuss some of this later, but let's say you want a medium market cap. You select mid cap or mid over a certain price, and it keeps narrowing down to a number that will be manageable to you. Now when you go to fundamental filtering, now you'll see there's a price to earnings ratio, price to cash ratio, stuff like price to book ratio, sales and revenues, net profit. If you understand what those mean, you have the option now to choose here whatever that criteria is. So if, say, you want when it comes to, say, net profit, right? Net profit, you say, I want a company that is doing over, let's say, over 10% net profit. You select that net profit, and it will filter out companies that have that criteria or meet those qualifications. And then if you say price to earnings ratio, you want something that is, say, over 5 or over 10, for example, it will again filter out only those that are over that price, over that value. And now you can realize that you're only left with like 14 stocks to pick from. And then you can still keep going on to other filter properties and eventually land on maybe a couple to 5 of them. And from there, you can choose to buy or not to buy. And the third point of filtering is technical, where if you understand technical analysis, there's indicators like RSI, which is a relative strength index. You choose. I usually recommend you choose stocks that are oversold. Oversold meaning people have been buying the stocks to a point where now there are no more. People have been selling the stocks to a point where there are no more sellers. So it gets to be called oversold. And these are some of the values you can use. Most people use oversold 30. And as you can see, oversold 30 only gives you one option. You can try maybe 40. It gives you still one option. Let's say not overbought, which is the opposite. And that gives you like 10. Anyways, the point was you have to narrow down to a manageable number, most preferably below 10. And then from this list is when now you can do further analysis. Now, apart from FinViz, there's other screeners. There's one called Google Finance. So you can just search for Google Finance, and it will give you that screener. So Google Finance does explaining of what the stock market is and what is going on. And it also has that option for you to do screening for stocks. So just Google Finance, and then it will give you that, stock market price and all that nice stuff. You select that, and you can now go into the Google screener page or Google stock market page, and it gives you a bunch of things about the stock market, the news, today's news. And here you can search for stocks. You can search for specifically stocks or indices or mutual funds or cryptocurrencies or whatever fiat currencies. But generally speaking, when you go to Google Finance, it kind of helps you with the stock research. The other one is called Stock Fetcher. So you search Stock Fetcher on your Google, and it will give you that. And you can see this one specifically even has a tab for Stock Screener. And under Stock Screener, now you can see you can screen in terms of the industries. So if you are looking for a financial industry kind of stock, you go to finance. If you're looking for consumer stuff, you look for consumer. If you're looking for technology, it's computer and technology. But generally speaking, you have now a way to filter out first based on the industry. And then once you are in the industry, let's say medical, then in here you can have other filters going on. So all these are medical stocks, and as you can see, some of the screeners are not as user friendly as the other ones, but I'm just giving you like alternatives. Yeah, you can search specifically for what you're looking for, or you can have a new filter going on where you start typing. This gives you that specific way of like building a filter based on your criteria and all that. But best I recommend is Finviz because it's user friendly. It's right there. Everything is set. Now, when you have your list like that, what you need to do now is do an analysis. But for some people, you're wondering like, okay, what are these companies? What do they do? What I would recommend is try and look for a stock that, or a company that you are familiar with. So some of us are familiar with Facebook, and Facebook, you just type FB, which stands for Facebook, and it gives you Meta Platforms, which is the other name for Facebook. So when you type FB, it will give you Facebook, and you can see exactly what Facebook is doing. Some of us use, say, Unilever products. So stuff to do with like, I'm not sure what products are Unilever products. Like lotions and all those other cosmetic stuff are usually Unilever. So if you type just there Unilever, what is the name? Yeah, Unilever PLC. That's for Unilever products. I think Vaseline is one of those lotions and stuff that is produced by Unilever. So if you're familiar with that product, there's always a company behind it, and you can find it in the stock market. Stuff like Colgate. Colgate is also a company. You can find Colgate, in the stock market. Wait for it. Yeah, Colgate, Palmer, something. But we never know the rest of the name. But as you can see, Colgate is also in the stock market. So whatever product you're using an Apple phone, there's Apple in the stock market. You're using Google, there's Google in the stock market. All those names that you know and maybe excite you are the first ones you need to look into when you're starting to invest. But stuff like Apple are a little bit too expensive. Stuff like I know some people are familiar with like Tesla because of Elon Musk. Those are a little bit expensive. But from here, you can now understand how the stock market works and pick a stock that you're familiar with and therefore can invest in. So once you're done with the screening and you have your watch list of 5 to 10 stocks, next thing to do is analyze them quantitatively and qualitatively. And I think I handled that in a different webinar, but one of those things you can use to analyze quantitatively is using what I call TradingView. TradingView is a site where you can look at the charts of that stock. So if you just go to tradingview.com, you'll have a page like that. And on this page, you can just select charts. I also failed to tell you that TradingView has a screener, a stock screener. So if you're also looking for a screener, you can find it on TradingView. So TradingView will load the chart. The chart looks like that. And you can just search for whatever stock that you're looking for. Let's say Colgate. Colgate is a CL, I think. Yep, CL. So when you come here also, you can search for CL for Colgate, like that. And it can give you that that stock. And on TradingView, make sure you're selecting NYSE or NASDAQ. So anything that has NASDAQ or NYSE, it means it's in the New York Stock Exchange, but these other ones are in different countries. I wouldn't recommend you choosing those. So make sure you're choosing the one that is NYC. And as you can see, the graph is there. You can zoom out or zoom in, depending on whatever you want to see. Change the view from day to week, week to month, all that view. Long-term, short-term view, whatever it is, that's that. So like I said, TradingView has a screener too. And just like any other screener, you have your screening options, performance, valuation, dividends, income statements, all that. You can use that as a criteria to filter. And here you can see there is adjust filters, where you can adjust what country the stock is from, which exchange the stock you are looking for, which asset, is it a stock, is it an ETF? So you can do all this under TradingView. And then once you filter out what you're looking for, you can just go to the chart and look at the chart and then decide if you need to buy the stock or not. So after you've done all that, you need to understand a few things now. Now you want to buy a stock. One of those things I usually recommend people to know about is the order types. The order types is, you want to buy something, just like how you'd go to a market. You want to buy, say, a shoe or a bag of flour or whatever it is. You ask for the price. The seller will tell you this price is this number, let's say 10. And you as a buyer have that tendency to want to buy it for a much lesser price than the market price, unless you think it's a little bit cheap and that price is okay. But most of the time, for everything you want to buy, most people usually try to buy it at a cheaper price than whatever the seller is trying to sell it for. So if you just go to the market and say, how much is this? And they tell you it's 10 and you pay 10 and you walk away, that's called a market price, market order. You're buying the item at the exact price the seller is selling it at. So in the stock market, like whoever is watching can see, Colgate is trading right now at 779.22. If you go to the broker right now and say, I want to buy Colgate at the market price with what we call a market order, they will sell it to you at 79.22. But someone's like, you know what? That's a little bit expensive. I want to buy it at 78. So if you have a price that you wish to buy the item for, that's called a limit order. So a limit order is you're dictating the price you want to buy the item at. So if you're told this item, the price for it is 10, you say, you see, can you do 9? Can you do 8? And then the seller is like, you know what, it depends. Maybe come back later on in the day, maybe wait a few minutes, or maybe let's bargain and see, what price can we settle for. You might want 9, but probably end up getting 9.5, or you might want 9 and get 9. So that point where you know the price you are willing to pay, and you put out that order with the price you're willing to pay, that's called a limit order, which is a fixed price that you're willing to pay for a particular stock. Now, there's what we call a stop order. And a stop order is an order where you have a fixed price, but you want to buy at that price or better. Or if you want to sell at that price or better. So you put, it's like a signal that tells your broker that if this price goes to this level, I want to buy, but don't buy at that price exactly. If you can get anything better than that, please give it to me for that price. So those are the orders that go into when you're making your order. So there's a market order where you buy at the current price, which might change any minute. Like you can see Colgate right now is 79.20 when it was 79.22. So it can change. It can either go up or go down. And there's a limit order where you know exactly what price you want to buy it for, and you use that price exactly to give your order to the broker. And then there's a stop order where you your order is executed from that price that you want or better. So if you are selling at a higher price of as a given amount or better than that. Or if you're buying at that price, but better than that, which is a little bit lower, if it's possible. And once you make your orders and your targets are met, then it's time to sell. And also selling comes with those orders too, as in when you're selling, you can sell at market order, or you can sell at limit order, or you can sell at stop order, which means when you're selling the stock, if you sell it at market order, it means, say you buy Colgate at 79 and it goes to 86, and you're like, okay, let me just sell it at that price. Then you put your order there as market order, and if you're lucky, you will sell it at 86. But if it drops immediately after you put your order, you might sell it at 85, or you might sell it at 87 if it goes a little bit higher. So with market orders, they're a little bit tricky because you never get the exact price you wanted for that particular stock. But with limit order, say you're selling it at 86, that's you telling your broker you're specifically wanting 86. If it's not 86, you can't get it. So you wait for it to get to 86, and then the broker execute the price, the sell. Now with the stop order is, you say you want 86 or better when you're selling, which means the broker will be alerted when it hits 86, but then after that, they can get you something better than that. So, but not less. So that's how that goes. So make sure you use a limit order, at least a limit order or a stop order, to make sure that you're getting the right orders in. Okay. Now the process of buying and selling, once you've done that, you go into the process of creating a portfolio, which means you just don't buy one and call it a day. You buy one and keep buying if you have more capital. And the more stocks you have, it ends up being called a portfolio, which is a group of stocks that you own. So a portfolio is a group of stocks that you own. And once you have a portfolio, then now your duty is to make sure that that portfolio looks good. So stocks that are losing money, you sell them, while stocks that are making money, you keep them until they meet your target. And once they meet your target, you sell them and buy other ones, and those do also the same thing. So the act of maintaining your portfolio over time is also crucial, and you need to understand how that goes. I won't go into details about that. You do need to learn how that is done, rebalancing, evaluating the stocks and all that over time. Creating a good portfolio is a good thing. Now, to my last segment, which is before you buy stocks. This is like a conclusion of what I've just talked about. Before you buy the stocks, one, start with research about the stock, research about what stock investing is, learn about what goes into buying and selling stocks. Okay. If you have difficulty in doing so, find people who know how to do so, which means you're looking at people who are financial advisors, people like me, or companies like Olympus Financials. I know there are other companies out there that do the same thing, which is financial consultancy. Look into those who maybe you have a bank near you. Banks offer financial consultancy services, but as you know, they also charge a price for their services. So when you go invest with a bank, they'll give you financial advice, and you'll pay for that advice. So there is other institutions, financial institutions. So look around, or look to people like me, and you'll get the exact people who will help you along your investment journey. The other thing was, when you're investing, be objective. Don't go into the stock market with the idea of quick returns overnight kind of thing. This is a market that takes time. So when you're investing, have that objectiveness, that this is my goal, this is my plan, this is what I look forward 1 month from today, 3 months from today, 1 year from today. What are my expectations? What are my goals? And you can now tailor those goals to your needs as you go along that journey. Know those goals clearly, and then focus on those, and then that will determine how you perform in the stock market. So that concludes part of my introduction to stock investing. And now